Let's be honest, most of us want real estate in our portfolio, but we don't want to be an actual landlord. Between taking care of midnight maintenance calls, chasing down rent checks, and just needing a massive $50,000 down payment, standard retail properties just aren't realistic for busy parents or people trying to build passive income. But there is a better way. A way where you can invest in a multi-million dollar apartments, hospitals, and data centers for a price of one single share. They're called REITs, Real Estate Investment Trusts, and they're one of the most powerful tools available for long-term dividend growth investors. Today, we're stripping away all this Wall Street jargon. I'm going to show you exactly how they work, the pitfalls you must avoid, and the hidden math trap that tricks almost every retail investor when they try to analyze them. You can think of a REIT as a mutual fund, but for physical real estate. A massive company that buys up thousands of commercial properties, manages them, collects the rent, and then passes that profit down to you. But what makes them completely different from standard stocks like Apple and Coca-Cola is one very specific legal rule. By law, to avoid paying corporate income tax, a REIT must distribute at least 90% of its taxable income directly to its shareholders as dividends. Because they skip the corporate tax layer and pour almost all of their profit back into their investors, REITs typically offer significantly higher dividend yields than standard stocks. Plus, because rent is collected monthly, many REITs pay out their dividends monthly too, aligning perfectly with everyday household bills. Very nice for the retail investor. But there is a catch. Because they give away 90% of their income, they can't easily save up the cash to grow. To buy new properties, they have to borrow money or issue new shares. This means that their stock prices generally grow at a much slower, steadier pace than normal stocks, and they can be quite sensitive when interest rates rise. When you look at a normal stock, you check net income and the PE ratios. If you do that with a REIT, you will panic. Let me show you why using a real world favourite, Realty Income, ticker symbol O. If you look up Realty Income's audited 2025 financial results, let's have a look at it. Sainsbury's there, Tractor Supplies. So it looks quite a lot like an ETF or mutual fund prospectus form. Nice letter there from the CEO. Goes through different things that he's saying. Impressive building there. Well, let's skip down to the pages that we need. And this is what we need to look at here. The net income, basic and diluted. So that's $1.17. So inside the dividend policy, we can see it says that we distributed $3.22 per share to stockholders during the year. So let's do the maths. Dividends divided by income times by 100 to get your payout ratio. To a regular investor, 275% payout ratio looks like an absolute disaster. It looks like the company is burning through cash and the dividend is about to be cut. But this is a massive illusion caused by paper depreciation. In real estate, tax laws force companies to write down the value of the buildings on paper every year, which artificially crushes the net income, even though the real properties are doing just fine. To find the truth, we need to look at two specific metrics, FFO and AFFO. If we look at Realty Income's actual 2025 earnings release, they added the paper depreciation back. The FFO or funds from operations, was actually $4.27. And the AFFO, that metric subtracts the real building's maintenance costs. That came in at $4.28 per share. Now let's run the real maths using that $4.28 of true available cash. So dividends paid divided by AFFO times by 100 equals the true payout ratio. And as it shows in the dividend policy of the document, a 75% payout ratio for a REIT is incredibly safe. It means the dividend is fully covered and they still have 25% of their cash left to keep buying new properties. When you're building a long-term dividend portfolio, REITs are fantastic for boosting your cash flow, but you need to analyse them with the right checklist. So step 1, completely ignore the standard EPS and PE ratios. Step 2, find the AFFO per share in the company's reports. And step 3, make sure the AFFO payout ratio is below 85% for the safe margin of safety. Step 4, check the net debt to the EBITDA to make sure it's below 6x so they aren't drowning in debt. And one last practical tip for busy parents, because REIT dividends are taxed at your ordinary income tax rate, consider holding individual REITs inside a tax advantage account like an IRA and let the high yield income compound completely tax free. Investing isn't about getting rich overnight. It's about consistency, clear maths, and letting the compound interest do the heavy lifting while you focus on your family. If you want to see exactly how I manage REITs in my own portfolio, go and check out my monthly portfolio updates playlist. And don't forget to hit the subscribe button so you can follow me on my challenge to $100,000. Leave a comment and let me know where you are in your investment journey. I'll see you in the next one.